Now, in the second act, which begins in 1934, Mundell calls that the confrontation of national economic management and fixed exchange rates. The fixed exchange rates don't come until Bretton Woods, but it's but we can write. So Act 2 is here. Act 2 is the confrontation of national macroeconomic management versus a fixed exchange rate system. Established at Bretton Woods, but early bits of it were starting already in the late 30s. So this is 1934 to 1971, I think, or how does he date that? 1971. So here again, there's this issue that there's this contradiction between every nation, every finance minister, every central bank of every nation wants to say, well, I want to adopt policies that are going to be good for my country. On the other hand, they commit themselves to some kind of fixed exchange rate with other countries. These things are, these things cannot really be squared unless you have someone who's going to absorb all the contradiction. And so I'm going to give you, and that would have been the United States, which didn't do it. Okay. There was one idea, a couple of ideas, for how you could make these things work. Keynes had this idea, the Keynes-Bancor plan. Have you heard of that? Okay. Keynes was, of course, the predominant economist in Britain. And so when they were trying to think about putting the international monetary system back together after the war, they had some meetings, and in particular they eventually had this meeting at Bretton Woods, which is this resort in New Hampshire, where they created the post-war plan. But in the discussions back and forth between Keynes and his counterparts in the US before this, he was trying to promote this idea, that let's have a sort of world central bank. I'll call it the International Bank. And an international, a true global currency, which we'll call Bancor. Okay. And the way we're going to work this is that deficit countries and surplus countries will make payments to one another. The deficit countries will make payments to one another in this new invented currency called Bancor, okay, instead of gold. Okay. And the reason why we're inventing this currency is to make it possible for there to be to increase and decrease the quantity of it as need is, so that deficit countries can make payments essentially by borrowing. They can borrow, and that what they borrow is created out of thin air by the bank and transferred to the surplus country here. We've seen stuff like this, right, at the level of of a country, right? When we talk about when somebody inside the United States a deficit agent needs to pay a surplus agent, okay, and they don't have the funds to do that, okay, they can ultimately borrow from the central bank in order to do that, or they borrow from a bank that borrows from the central bank. So these are banks. So this is like expansion of the Fed's balance sheet instead of the Fed funds market or something like this. Okay, so it's a lender of last resort operation, but at the international level and in this Bancor currency. So Keynes proposed this. This is a sort of classic banking solution to this kind of problem. But the United States looked at this and they said, okay, let's just ask ourselves, which of these people is going to be us? Okay, which of these agents is going to be us? And which is going to be you? Okay, and it was pretty clear that this was going to be the UK and this was going to be the US. In fact, not only that, this was going to be all of Europe, okay, and basically everyone, and this was going to be the US. And so what this seems to the US to be is a mechanism for forcing the US to make a whole bunch of loans to other countries, okay, through this intermediary that they don't have any control over. Okay, that they're lending to this international bank, and the international bank is lending on to the UK and so forth. Now that, of course, that was definitely true after the war. That was exactly how the balance of payments was going to work because of the consequence of war. But it might not have gone on forever that way, but it was going to go on for a while that way. To make matters worse, Keynes insisted that to get around this deflationary impulse of the gold standard that he had seen before, he wanted to eliminate the so-called asymmetry of adjustment, which is that it's the deficit country that has to adjust, right? This is the survival constraint. It's the deficit country that has to adjust because you have to acquire, the international reserve somewhere. And so Keynes had actually proposed that we charge an interest rate on this loan, and we also charge an interest rate on this deposit, okay? So that instead of you paying, 3% on this, and that yielding 3% here, passing through, you actually you charge 3% on the deposit in order to encourage the United States to spend this money here, to buy goods in Europe, okay? This is money that if you hold on to it, it's just going to lose value, so you should spend it. Okay, this didn't go over well again. So not only are you forcing me to make a loan, you're forcing me to make it at a negative rate of interest. I don't think so. Okay, and so we didn't get the Bancor plan. We didn't get the Bancor plan. And inevitably, I think, it was an attempt to eliminate the survival constraint, eliminate the discipline that the deficit countries were going to be facing. The deficit countries were going to be facing big discipline because they were going to be deficit countries, and they were going to need to get goods from the U.S. in order to rebuild their economies after the war. And that's an awkward position to be in if you're a sovereign country and you want to control your own future. So what we got instead of the Bancor plan was the IMF. That was the U.S. plan. And the way the IMF worked, and works to this day, is this. Before writing that, let me just remind you how this works. In this system, in the Bancor plan, if deficits go up, okay, the central bank expands its balance sheet, the quantity of international money increases, right? The quantity of money increases if there's imbalances in the economy. So these imbalances are absorbed on the balance sheet of the central bank by an expansion in the quantity of reserves. Okay, think back to what the problem was that Mundell is thinking about. Okay, the problem is that the currency, national currencies, are expanding and international reserves are not, and so the international reserves get scarce. One way to get more reserves is to revalue gold. Another way is to create more reserves. This is the create more reserves way. Okay, creating more reserves as needed in order to maintain the international balance. The IMF situation was to fix international reserves, okay, to create some paper gold, okay, but of a fixed quantity. Okay, here's how the IMF works. Okay, there's the International Monetary Fund here. This isn't actually the way that it does its accounting, as you may remember from problem set 1, okay, that they have this complicated, weird system, okay. But the logic of it is this. Here's a member country. And the IMF requires member countries to deposit gold and their own national currencies in the bank. And issues basically deposit accounts, which it now calls SDRs, special drawing rights here, which are kind of, think of as a kind of deposit account here. So there is, these SDRs are an asset of the member country, which it pays for by sending gold here and by creating national currencies here. And all of the different countries do this. And so the IMF winds up with all different kinds of national currencies here. Some of them are important national currencies and some of them are not, okay? So the important ones are the majors, as we saw last time, in particular the dollar. This here, these deposits, can then be used to make payments from deficit countries to surplus countries. You can make those payments by paying in SDRs. So if I have some SDRs and I'm a deficit country, I just pay them out. And so the quantity of deposits that I hold change, okay? But eventually I hit zero. And when I hit zero, that's the end. The quantity of deposits here doesn't change. It's just being transferred back and forth, as opposed to the Bangor plan, where imbalances cause an increase in reserves, an increase in the quantity of international money. Here, the quantity of international money is fixed. And not only that, when you hit zero, you've paid out all your SDRs, okay, and you still have a deficit. What do? Well, we all know what you do. You go to the IMF and you say, I now need to borrow, okay, from you. I need to borrow in order to make my payments. And the IMF says, okay, we'll lend you some money, but it's going to cost you. And it's going to cost you in interest rates, okay, not negative interest rates, okay, but also conditionality and of economic policy and all of that, okay. So this is a very different, this is the asymmetry, in fact, that Keynes was trying to get around, okay, that deficit countries are the ones that have to adjust and surplus countries do not have to adjust. But that's how the IMF was created. Who knows what would have happened had Keynes lived? Keynes, this is my own little pet theory, the famous economist's death theory of international finance. Okay, that Keynes died shortly after this, and so he was not around to see it implemented and it may have been that he accepted this with the thought like, well, it's as good as we can get now, and later on we can fix it, whatever. Anyway, this is what we got. This is what we got. And so this is a discipline system as opposed to that which is an elasticity system. Maybe this would have been too elastic. Maybe this created too much discipline. For a while, it didn't, though, because the shortage of SDRs, the shortage of ultimate international reserves, was mitigated by the expansion of dollars farther down the hierarchy. So let me explain that. This is a theory not of Mundel's, but of Charles Kinderberger.